Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Intel. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Callie. Well, we saw the S&P 500 index break through a new high. And if we look at the actual chart, we do see a little bit of a chop in the marketplace. A lot of people were talking about SPX 4000, but that rhetoric has kind of died down a little bit. But we're seeing some interesting things in the VIX index. You could call it good news overall, but it's definitely a talking point that I want to address. What do you see going on in the markets going into the end of this week?
Yeah, definitely, Brian. Well, first of all, I want to wish a happy birthday to the bull market because exactly 1 year ago, the S&P bottomed after a 34% slide fueled by COVID fears. It's crazy to think about where we were a year ago. I'm thinking a lot about it today, especially given that we are seeing a lot of good news because a year ago, we were all locked down in our houses with a lot of justified fear about the future. And stocks powered through that in a big way, too. The S&P is up about 76% since then, in its strongest return in the first year of a bull market in recent history. Who called that? Not me, that's for sure. I wasn't a big believer, but it happened. And, like I said, we're sitting at and looking at a lot of really, good, exciting developments today. And we could be staring down the end of the pandemic in a few months. By the way, if you want to read more about our analysis on year 2 of the bull market, check out our latest weekly viewpoint on Ally's Community Hub. We wrote all about it there and published it on Friday, so it's nice and fresh for you. So super exciting day in that regard for the markets. But other than that, it's pretty quiet out there, Brian. Stocks are pretty flat today. Last I checked about 15 minutes ago, and yields are down. Like you mentioned, we are struggling with the 4,000 level on the S&P 500, but it does seem like the yield anxiety is gone for now, with the S&P near record highs and no major headlines to trade on. Right now, literally right now, we're getting some Congress testimony from Fed Chair Jay Powell and Treasury Secretary Janet Yellen. So that could be interesting. We don't expect the story to change there. We expect Powell and Yellen to stick to a very consistent message, like they've had for the past, year probably. Messaging lots of stimulus and a low chance of runaway inflation and low rates. That's more in Powell's, ball game, but, Yellen's beside him. But anyway, we expect the messaging to stay the same, but the market could take that messaging negatively, especially if yields start moving. So that's something to watch for, but we don't expect that to cause any market panics. Powell and Yellen are scheduled to continue their testimonies tomorrow too. So it's not over today. They get back at it tomorrow morning. So that's something that we'll watch tomorrow. Otherwise, not much happening this week. And overall, we still expect stocks to drift higher through the next few months. And we wouldn't be surprised to see maybe a quick pullback in the 5 to 10% range. It could happen, but we would be equally not surprised to see, smaller pullbacks or, a market that just drifts higher. There's a lot of buying pressure out there, a lot of buying interest, and that could keep pullbacks pretty shallow. So yeah, not much excitement other than the bull market's birthday. But Brian, I know you said that there's some good news in the VIX, so I want you to tell me about it.
Yeah, the VIX isn't really looking for a pullback. And I'm kind of excited about this because I'm tired of talking about the fact that the VIX can't get below 20. Because guess what? It has, and it has for a couple of days. Yesterday, the VIX index actually closed at 1888. That was the closing print on the VIX index, implying that the implied volatility in the S&P 500 index 30-day option contracts has finally stayed below 20 for more than a day. We've had it touch that the 20 level a few times since the March lows, a year ago, as you pointed out. And I wanted to say whoop whoop to the marketplace overall for the 1 year anniversary. Got to wish them the best, the market overall. But with that said, it's just one data point, but it does show that some of the nervousness of the marketplace is finally subsiding. And it's even more important to me to actually look at the May futures contract. That is the futures contract that represents the May options for the actual VIX index. And that May contract is below 25%. Now, that was stubbornly around 28, 29% just a few weeks ago. And we see the April contract all the way down to the 22.25% level. So in general, the fact that the VIX is finally waning a little bit and has definitely established a position below the 20% level is just a good sign for the marketplace overall. Now, we've been talking about the S&P 500 index and the 4,000 level, and there's no magic with the 4,000 level, except for the fact that big round numbers, a lot of indexes struggle with breaking through, and it's just a fact of life overall. There's no actual reason why that seems to be the case, but the VIX being below 20 is basically the VIX saying that we're okay with it getting to 4,000, if you will, overall. So today's stock we're going to look at is Intel. And before I pass it over to you, I just want to look a little bit at the chart on Intel. We see recently Intel has broken through the June high that it had. Now, in June on the close, it actually closed a little bit closer to the 65 level. And yesterday, the VIX was above 65. And you see here by this little conglomeration of closes and bars on our chart that it's really kind of struggling to get through that level. Now, ideally, we're down a little bit. We're at 64.42. Oh, I'm sorry, at this point in time, 64.43. But we're right on that resistance level to the upside. So it would be really good if we could break out to the upside and have a little bit of a close to the upside. That would be a good sign overall for the chip maker, I have to admit. But we do have a very strong upturn in the marketplace too. So I think that's part of the reason why it's pausing here. And as we know, with chip makers, news is a big thing overall. So what's your outlook on Intel just going forward?
Yeah, Brian. So yeah, let's talk Intel. A lot of things to talk about there. And I love me some semiconductor talk, so I'm really excited for this. So Intel, one of the largest semiconductor stocks in the market, probably the largest in the US stock market. It produces chips and processors for a bunch of products, mainly and including computers. So you might know it from the days of the 2000s when it was producing chips for like compact computers. Intel, in the stock world, is one of those rare stock play picks where we're seeing good, compelling stories in the short term, the medium term, and the long term. So let me tell you what I mean, and I'll start with Intel's prospects for the short term over the next few weeks. So Intel has a lot of exciting things going on for it in the short term. It just reached a new post-COVID high back in January. It has fallen quite a bit since then, quite a bit being a few percent, but it is testing that high again. So, good story if you've looked over the past few months. A big fundamental thing too, Intel just switched CEOs. And the new CEO is expected to speak later today about strategic plans for Intel and its manufacturing. Wall Street analysts are slowly coming around to the new CEO's vision, and today's event can provide some needed clarity on Intel's operating plans over the next few years. So there's that. We have an event coming up today. Intel could also be an interesting play over the next few months too. And I don't want to spoil Brian's story quite yet, but I think we're going to be looking over the next few months in options. It's lagged the market and most other semiconductors in the rebound over the past year. We understand that there has been some fundamental reasons why. We're not arguing that at all. But we think that the CEO change could ignite a little catch-up rally in the stock. Intel has also lagged more because it's been a more globally exposed stock. And that's been a disadvantage for most of the rally for globally exposed stocks because investors' preferences are shifting. They were to more domestic, US-focused tech stocks, but But the good news is that they're shifting to more value, globally exposed companies now. That's why you're seeing the Dow do so well, for example. So that shift alone could help boost Intel through the end of the year. So long term, Intel could also be interesting as tech evolves and we move into a 5G world. That's right, I said 5G. It's one of those stocks that isn't exactly a sexy tech stock, but it could eventually benefit from the same forces that hotter tech stocks benefit from, like the shift to 5G example, for example. Ooh, can't talk today. That might be a good scenario for investors, thinking about the same forces pushing it higher, but with a different value, because we all know that tech stocks are looking pretty expensive these days. Now, I will point out that there's a lot of competition in the semiconductor space. So there's a chance Intel is eventually edged out by a younger, nimble company. And I think that's the big worry on Wall Street right now. You have the younger semiconductors growing quickly, and Intel, being an older stock, isn't as nimble. Can't really shift to today's tides and trends. And there are other disadvantages to a bigger semiconductor company that made its name off of desktop computers, like I mentioned earlier. They're going out of style, and Intel still manufactures its chips in house, which has been a big thing for Wall Street to rag on because it's more expensive. But on the other hand, Intel definitely has the brand name advantage, and it has deep pockets too. That's the advantage of being a bigger tech company. And change seems to be coming, so we're excited to see what happens down the road. All right, so Brian, that's my rundown on Intel. I want to hear about how you'd play Intel options, but before I do, I'll remind our viewers to drop your questions in the chat, because at the end of the show, Brian and I will be answering your questions live, and hopefully we'll have some good answers for you. All right, Brian, I'm going to pass it to you. Tell me what you're seeing in Intel options.
All right. Well, I'm sharing the Ally Invest option change right now. We do see Intel is down a point today, which doesn't help us on the charting aspect of Intel overall. If we would have got a little bit of a pop-up, that might have helped a little bit more. But because of that, I was actually looking at a long call strategy, but I'm going to adjust the strategy a little bit by the fact that we're seeing a little bit of downward pressure. We're still going to go long. We're going to go out longer in time. You talked about the 5G situation. I think it's time to start thinking about that. Just that entire world of 5G and companies that may benefit from this is just something to think about overall. And that's part of the reason why we're looking at Intel today. So we do see they got earnings in April. Right now, the anticipated earnings date is April 22nd. I'm going to go out to September. So we're going to live a little bit longer on this Intel trade, but then I'm also going to change it up from just a straight out long call, which we're seeing here inside the options playbook, to an actual fig leaf. Now, a fig leaf is a term that we coined inside the options playbook, but it's basically using that long in the money call option as a surrogate for the stock and then selling a shorter term option against it. A more technical name would be the leveraged covered call or a leaps diagonal. I like the term fig leaf because you don't actually own the stock, and it just kind of means you're kind of covered in this scenario. And that if you do get called away, you're going to have to do something against that position. So let's go in and look at the strategy right now. So Intel, once again, down $1. I'm going to scroll all the way down to the September expiration. We have the calls on the left side. We got the puts on the right side. And we're going to look for a decent delta. We want something that gives us a lot of stock price representation. So if I look at the 55 strike with the stock at 64.56, this is a live show, so the quotes are moving. And we see that that delta is about 78, not quite 80, but it's fairly close to 78 here, fairly close to 80 at 78. So what we're saying is that if the underlying stock goes up 1 point, the option contract should go up about 78 cents. Now, that's all in theory, but it just gives you a realistic expectation as to how your option might move as the underlying stock moves. All right. Now, one other thing that I always pay attention to when I'm buying longer term options is approximately how much time premium I am buying. And if I look at the call, or I look over on the put side of the chain, that actually gives me just an indication of the approximate time value. So we see the put, we're going to call it $2.30 on the midpoint. So I'm going to be paying that amount of time premium. Now, this is how buying leaps differs from buying the stock outright in that I don't buy time premium when I buy the underlying stock. I am only buying that stock. Now, when I'm buying this leap, it's still an option contract. It still has an expiration date. So when I do this trade, I want to be cognizant of that. And especially when I'm doing a fig leaf, because my goal, if I'm going to take the approach that I'm going to sell some calls against my longer term option contract, not necessarily a leap, but it's longer term. In my world, the definition of a leap, long-term anticipated security, is more than 9 months out. Here we're going to go 178 days. And so we're looking at about $2.30 worth of time premium. We're going to go in the short term, especially because not quite excited exactly where the chart is at. I'd like to take a position. If I was thinking about buying 100 shares, I would be buying one call option. Now, this is just considered a paper trade overall, but I'd be buying one call option. And then I'm going to scroll up to the short term, and I'm going to go as short. I'm going to go pick a shorter term expiration because I really don't want to be assigned on this position. And I'm going to try to avoid that assignment. So how can I do that? I can go a little bit short term and I can go a little bit up and strike, but I'm going to be sacrificing the amount of premium that I'm bringing in. But then again, I didn't pay the full price as buying 100 shares of stock. So this is an alternative to a covered call trade, but we're going to have something that's going to look similar, but not quite. Hence the name, the fig leaf overall. Okay. So April 16th expiration, we're going to avoid earnings. I do not want to be in a short call position going into earnings. I don't want to limit my upside and then have all the downside. So April 22nd was the expiration date. I do not want to go out past that. I'm going to look at selling an April 16th 24-day out call option. And now I'm going to scroll down here. At the money option would be the 65 strike. That's approximately at the money. So here's the decision that you want to make. Now, could I go and sell the 68 and bring in about 92 cents at the midpoint, 91 on the bid? Very tight markets in Intel, which is a good thing. Or do I want to go up a point, sacrifice some premium, but get a point further out of the money? And when it comes to the fig leaf, I'm going to err at going out in strike, going up higher and receiving less. So I'm going to look at the 69 strike call, still getting a decent amount of premium. We're talking about 69, actually 68, the 69 strike, we should say we're going to get 69 cents, right? So let's pretend that would be the case. And this would be the actual trade for the week. We would be buying the paper trade. We'd be buying the 55 strike call and then selling the 69 strike shorter term call against that position. I would do it all as one trade. That would make it the fig leaf. We'd be doing it all as one trade to make life simple. And our net debit to the account would be about $10.83. We would work the trade a little bit. Hopefully we would get somewhere close to the midpoint. And as always, got to emphasize, this isn't meant to be a recommendation. We're just trying to learn here on the stock play of the day. So the official paper trade for the week, it's in the right rail that makes it official in my book. We're buying the September 17th, 2021, 55 strike call option with a high delta. We're selling the shorter term, April 16th, 69 strike call option. We're doing this for a net debit of $10. Well, let's look at the midpoint. Let's call it right there, $10.85. We're going to work this trade a little bit. We do want to protect ourselves on the downside. If the underlying market came down to my strike of the call option that I'm buying, I'd think about getting out of this trade. And we also want to pay attention to that 69 level. If it gets to that level, I want to set an alert. I want to adjust my trade. I do not want to be assigned on the short term. I wouldn't mind that it got to the 69 level because my long call option is going to go up just as much as, or go up more than my short option, and I should have a profit on that position. But ideally, that's my outlook for the marketplace. So let me take 2 seconds to run down now that we got the official paper trade in the right rail, and we'll look at the profit and loss graph real quickly. Got my screen all zoomed in here. So, all right. So this is what it would look like if we put this trade on today at expiration of the short term. We're looking right at the 70 strike from 70 or 69, actually. From 69 on up, I cannot make any more on this position. So I want to be aware of that level, and I want to do something. I want to adjust this trade. I want to close out the trade. I want to close out the long call. I want to do something once if it does get to 69 before that April expiration date. Now, on the downside, if we own long stock, we would have all the risk of owning long stock. In this situation, from 55 on down, we cannot lose anymore. And I always like to propose, and I'm kind of highlighting here, that if it does come down to 55, we do have a longer term option contract. And you see that the colored line right here, that's as of today. So in the short term, if it comes down, we don't have as much risk as if it comes down closer to the expiration date. So a lot of times, if it did come down to that 55 level, I would just think about getting out of the trade. Now, I like this strategy overall as, once again, a FOMO trade in that Intel has had a big run up. We have some potential good news coming out, or we don't know exactly what's going to happen with the 5G, but it could be a benefactor here. But we have had a big run up. So how could I do this without all the risk of owning the stock outright? Buying in the money leap. A little bit nervous about what the chart looks like right now. We'd like to see it break out, but if it doesn't, I'm going to sell a call, bring in some premium, give me a small pill to land on if the underlying actually does not break through that resistance level and starts on a little bit of a downward trend. But overall, we're looking at a longer term position in Intel. All right. So I'm sure we got a few questions out there, Kelly. Let's jump to the chat box and see what we got.
Yeah, we do, Brian. Let me tell you, our viewers are really quizzing us today. All right, so I have a question from Ethan, and I'm actually going to take it myself, Ethan. Hi, thank you for asking, or thank you for submitting a question. So Ethan asks, what do you think about Cathie Wood's Tesla target price of $3,000 by 2025? Oof, that's a tough one, Ethan, but I'm going to try and answer it. So yeah, let's walk through this. So to start things off, we can't talk price targets or we can't talk about other firms. So right off the bat, I can't comment on that. But I will say that Tesla has had some good momentum going for it. I mean, that's obvious if you look at a one-year chart. We have seen Tesla sell off over the past few weeks, quite a bit actually. But, you know, on the whole, Tesla is up a good bit since the, March 2020 bottom. Tesla could continue to rise with the market's momentum, but we are a little concerned long-term with the competition Tesla could face in the electric vehicle space. GM, General Motors, announced this year that it'll start working electric vehicles into its fleet with targets by 2030, and more car manufacturers could follow their lead. That's a very good possibility. So it's tough to say fundamentally where Tesla will go, Ethan, but it does have a lot of momentum behind it. So kind of take that as you will. All right, let's see if there are any other good questions. Let's see. So Street Plug, hi Street Plug. Street Plug asks, what's your best option strategy, leap or stock? And that question is a little vague, Brian, but tell us a little bit about what you're seeing overall in the market and, what a good option strategy could be to play, maybe the lower VIX or, a higher market if we break through 4,000.
Well, yeah, I mean, you can always look at using options as they were first intended to as a way to reduce risk. And that's usually the way we talk about them on the stock play of the day. Like today, we're looking at Intel. We're thinking, well, I'm thinking about buying 100 shares of it, but I'm a little nervous by looking at the chart because it's been parabolic on the way up overall. So how can I do it and reduce my risk? And if we bought the leap option contract instead of the 100 shares of stock, now I'm doing it on a one-to-one basis. If I was thinking of 100 shares, I'm going to buy one leap option. I'm actually reducing my risk down to about 17% by paying that premium. It was I don't remember exactly, $11, well, $10 after we did the fig leaf, right? I'm just trying to find the trade right here real quick. And if I did that trade overall, and I'm looking at that strategy, a way that I could do this in the marketplace is to actually use an ETF. So if I'm looking at the SPYs, I'm looking at some other indexes, maybe I want to look at the QQQs because I want to do it in the NASDAQ. This is a great alternative to just buying that index or stocks in that index, having limited and known risk. And like I said, on the upside, we're moving a lot like the underlying stock, but on the downside, we get some protection. So the way Delta works is we accelerate as we are correct on our forecast within the money options, and it decelerates as we are incorrect. So I always like to pay attention to the strike that I'm buying and think about adjusting or selling or getting out if the underlying comes down to my in the money call strike. And I'm choosing my words wisely here, because that is, this scenario only happens if I'm buying in the money option contracts overall. So I'm going to flip over to the options playbook, and I'm going to highlight this strategy. It's actually in the rookies corner, and it's actually buying leap calls as a stock substitute. So I'll click on that. And if you're interested in this, we've talked about it as a lot of FOMO trades, but if you're thinking about participating in the indexes, you just want to take a position, but you don't want all the risk of owning the market outright, ideally, right? A way to do it is to actually think about buying longer term options on ETFs that track the indexes.
All right, good answer, Brian. All right, so we have a question from longtime caller Wayne. Hi, Wayne. So Wayne says, first of all, happy 1-year anniversary. Thank you. The bull market thanks you, Wayne. And he asks, Brian, if Intel is bullish today, is it better to wait a bit to sell the short leg and collect some more premium at that strike and expiration?
Wayne, I don't mind that, but the thing about it is, and I was highlighting this, when we were thinking about Intel, we were looking at the chart yesterday, and we had a little bit of a breakout in Intel. So I'm going to highlight the chart again here. And this level, right around the 64 level, kind of scares me. And we see that we're just hanging there today, which was, right around the June high. So it makes me a little nervous to kind of wait around to see if we do break out. So in Intel in particular, I would prefer to buy the leap option and sell the call option at the same time, or at least within the same market session, just today by looking at the underlying chart. But I don't mind that strategy, Wayne, where I go in, I take the position, wait a little bit. If we do get a little bit of a bump to the upside, selling the call at a later date. And that is much more common when we're looking at just a flat out covered call. A lot of people that will buy the stock outright will then wait and hopefully get a pop-up and then sell the call against the position. And that is a much more common way when you're thinking about actually owning the stock.
Gotcha. Good answer again. You're a pro. All right. I see a lot of questions in the chat about our outlook, and I'll address that quickly. So overall, we are thinking about the stock market. We do see stocks maybe drifting higher through the end of the year. Chance for maybe a 5 to 10% pullback, like I said earlier. But there is a lot of buying pressure out there. So there's a chance that we may not see that deep of a pullback. Pullbacks might be shallow for a while. I know Ethan asked about Ally's outlook on inflation, interest rates, mortgage rates, and real estate prices. Ethan, that's a loaded question. Inflation, we think runaway inflation is a low risk. It's going to take a lot of market force to, push inflation beyond or consistently beyond 2% year-over-year growth that the Fed is looking for. So we think that runaway inflation is a low risk, but inflation is a very normal part of economic recoveries. So don't be surprised if we see a little bit of inflation growth. For everything else, I'll just tell you that we are publishing a quarterly outlook on April 9th. We write an outlook every quarter, and we write weekly as well. So definitely keep an eye on Ally's Community Hub for answers to those questions, because we'll likely cover them in the outlook. All right, and it looks like we're hitting up on time, Brian. So I'll go ahead and wrap this up. Thank you for joining us, and I'm going to remind you that Brian every week wraps up the trade that we talk about on Tuesdays on his overtime show on Fridays at 12 p.m. Eastern. Brian goes through the paper trade and tells you how we did. I mean, hopefully we're doing well, so we'll see. But I'll pass it to you to wrap things up, Brian.
All right, everyone. Well, that's going to be it for this edition of the Stock Play of the Day. Please Remember to click subscribe and ring the bell, and we'll see you this Friday on the Stock Play of the Day Overtime Edition. Thanks for coming.